Same house, same street. One decision in month 3 changed everything. There are 2 houses on the same street, in the same suburb, bought in the same year, for nearly the same price, $448,000. Same 3 bedrooms, same 2-car garage, same backyard facing the same community park. 7 years later, one family has a 9-month emergency fund, a retirement account that's growing steadily, and they sleep fine at night. The other family sold that house below what they paid for it because they couldn't afford it anymore. Same street, same purchase price, nearly opposite financial outcome. It wasn't because one family earned more. It wasn't because one family was smarter about money in general. Here's the uncomfortable truth. The entire difference came down to one decision, made in month 3 after they moved in. This isn't about the house. It isn't about the price of real estate. It's about how one small financial decision, one that felt completely reasonable at the time, can create a ripple effect that plays out for years. And most people are never shown how to see that ripple before it's too late. According to Federal Reserve data, nearly 37% of homeowners take on some form of equity-based borrowing within the first 5 years of ownership. A HELOC, a cash-out refinance, a renovation loan. Read that number again. More than 1 in 3 people, at the most financially vulnerable point in their lives, right after a large down payment, right after a move, chooses to borrow again. Why does this happen? Not because these people are careless. It's because a new house creates what I call the lifestyle multiplier, a chain reaction triggered by one large purchase. Here's how it works. You buy the new house. The old living room feels too small for the old sofa. So you buy a new sofa. The new sofa makes the old carpet look dull. So you replace the carpet. The new carpet makes the bare walls feel empty. So you call a contractor for fresh paint, then built-in shelving, then backyard landscaping to match the new interior. I am not done yet. Each of these decisions looks small on its own. $2,000 here, $4,500 there. But added up in the first 12 months alone, the average new homeowner spends an additional $18,000 to $24,000 beyond the cost of the house itself. According to recent home renovation industry research, that's before interest, if any of it was financed through a HELOC. And this is where the real problem shows up. HELOCs carry variable interest. Borrow $20,000 at an initial rate of 7%, and if rates climb to 9% 2 years later, your payment can jump by hundreds of dollars a month, without you having done anything wrong except borrow at the wrong time. That's before we even get to opportunity cost. Money spent servicing HELOC interest is money that never reaches compound growth. Over 20 years at 7% returns, that $20,000, if invested instead, becomes approximately $77,000. Not a small thing to trade away for a new kitchen island. Now let's go back to those 2 houses. Robert and Jennifer moved into their new home full of momentum. In month 3, they took out a $35,000 HELOC to renovate the kitchen and primary bathroom. Granite countertops, a walk-in shower, custom cabinetry. Their reasoning made sense at the time. The home's value goes up anyway. This is an investment. Between the HELOC payment and the mortgage, their monthly expenses rose 34%. Year 2, the AC unit failed. $6,000 put on a credit card because the emergency fund had already gone toward renovations. Year 4, the HELOC rate climbed. Year 7, they sold, not because they wanted to move, but because they couldn't afford to stay. Marcus and Carla, 10 houses down that same street, made a different choice in that same month 3. The old kitchen stayed, the old sofa stayed. They postponed every cosmetic renovation for 2 full years. Not because they couldn't afford it, but because they were waiting until their emergency fund reached 6 months of expenses first. Year 3, they finally renovated the kitchen, paid in cash, from savings, not a loan. Year 7, their mortgage was paying down faster. Their retirement account had compounded without interruption, and they still live in that same house. The math is brutal. It wasn't income. Marcus and Carla earned almost exactly what Robert and Jennifer earned. The entire difference was one decision in month 3. Borrow now to feel finished, or wait and pay cash to actually be secure. If you've just moved into a new house, or you're about to, here are 7 rules you can use immediately. 1. Don't make any major renovation decision in the first 12 months. Let a room feel unfinished for a while. That discomfort is temporary. Debt isn't. 2. If you do have to borrow, choose a fixed-rate loan, not a variable-rate HELOC. Predictability matters more than a slightly lower starting rate. 3. Ask yourself, does my emergency fund still cover 6 months of expenses after this renovation? If not, wait. 4. Apply a 90-day rule to any renovation decision over $2,000. If you still want it after 90 days, go ahead. 5. Separate structural repairs, a leaking roof, faulty wiring, from cosmetic upgrades, a kitchen, fresh paint, landscaping. The first is urgent. The second can wait years. 6. Don't compare your interior to a neighbor who's lived there 10 years longer. They renovated gradually. You're only seeing the finished result. 7. If you do choose to borrow for a renovation, that's not automatically a mistake, as long as it's an intentional decision based on your own numbers, not an impulsive reaction to a room that feels unfinished. This isn't financial advice, and every debt situation carries different risk. If you're considering a HELOC or a large renovation loan, talk to a professional who understands your specific financial picture. Here's what this looks like in practice. This week, check exactly how long your emergency fund would last if one income stopped tomorrow. Not a guess, an actual number. This month, write down every renovation urge you've had since moving in and mark each one as structural or cosmetic. This quarter, if you do plan to borrow, compare at least 3 fixed-rate loan offers before accepting the first one your bank shows you. Robert and Jennifer's house belongs to someone else now. Marcus and Carla's house still belongs to them, and it will keep belonging to them. Same street, same starting point. Different decision in month 3. Real wealth whispers, fake wealth screams. And a house, no matter what it's worth on paper, is only really yours if you can still sleep after paying for it.